Really, what happened?
Uh, my girlfriend just didn't drink any, left me with a giant pot.
Dangerous.
Yeah, I always have a strong one to start and then a big weak pot to finish.
Nice. I had a little bit of weird hours this morning, so I also feel like I was super caffeinated, but I think I'm back to normal now.
S- I'd love to drink more green tea, like the Chinese style.
Hmm.
I find if you drink a lot of it, it hits. It's a bit more potent than coffee if you have it strong, and it's not the same, but it's good.
Interesting. I do like a good green tea, but I've not had it hit the same way.
You got to have it really strong.
How do you make it really strong?
You just use loads
Okay.
and re-steep it instead of clearing it out and using new. You just add to the tea that you've already bubbled. It gets very
Got it.
thick. Yeah.
All right. So I think it's just us four on today's call. What do we have to go over today? There's some macro things to discuss, and then we've got you had something that you wanted to discuss on Dynatrace, right?
Yeah.
All right, cool. I guess we can start off with that first.
Okay. I will share my screen. Okay. So I go through the model. I have to show you guys what I'm seeing. So guidance for Q1 is 392 million. And for me to get that, I had to really drop. So I've included a 15% reduction in efficiency of the sales team. And then on top of that, I've added some seasonality in customers because this ARR, net new ARR, is always very seasonal. Um,
Hmm.
they said that 25 was going to have seasonality similar to 2024. And so I'm not sure, and maybe Mo, you have an insight to this. Is is the seasonality more likely to be driven by customers or ASPs, or is one of those likely to be static?
It's going to be driven by them like closing, a deal. So that's going to impact it'll depend. So, um, a good way to understand this is, if I have, I have got like deals in the pipeline, that's going to be a mix of new logos and expansion. And, if customers push back this quarter because I can't get a deal signed or it's taking a little bit longer to close something, the way to understand this is it's going to be both an impact to um the I'm not going to get the uplift to existing customers, and I'm also not going to get the new logo. So it's going to be a small, reduction to both.
Okay, so they should be, you're saying they should really be correlated.
Yeah. What I'm saying is that the seasonality in revenue is the result of like deal dynamics that happens. And deal dynamics impact both new logos and expansion logos. So I would look at seasonality at like the headline level, not necessarily at the customer or ASP level. And I would also break it down from like a ACV instead of a AC instead of an ASP. That way you can think more about like where the shift in ACV is coming from. Is it coming from new prices to new logos, or is it coming from like an expansion of an existing deal? Those are things that we just want to kind of clearly build into our model.
So for ACVs, really that's going to be ARR.
Yeah, you can use ARR as the you can just divide that by the number of customers.
Right, okay. So so you're saying that there should be, all right, so let me explain what I've done then in my model. So I've got this 15% reduction in Salesforce because 15% have been reassigned. Uh, I'm assuming this will clear up in Q3, and in Q2 they'll have recovered like 1/3 of that efficiency. Then I've added this seasonality on top of it. Then I've matched the quarter over quarter. Well, okay, so I've matched the ASP of net new ARR. So yeah, the average. So this is just um, the for the net new change in customers. Uh, yeah, I've used the average over this last year, and then I've factored in these two factors.
Got it. Okay, that was
Um,
going to be a follow-up question, which was like, how is that percentage of sales teams reassignment impacting? Like, what is that? What is that impacting? Yeah.
yeah, it's basically just minus 15 customers. So then, um, yeah, I've set this 450 number to be uh, like some level higher than Q1 here because they had the same in both 2023 and 2024. They were targeting the global 500, and so clearly, in my opinion, something is wrong here uh, with the ASP. I mean, in my opinion, like these are not consistent, right? So I don't know if this is more of a 2023 type ASP or more of a 2024 type ASP. So I went kind of in the middle, but leaning towards the 2024, the lower number, just to be conservative. So so I took 450 and 75 customers, which is kind of the low end, assuming because they added 400 here, it seems like there is momentum in customers, and I've factored in uh, the deceleration from the go-to-market transition here. So it takes back to 2023. So I'm kind of on the low end of both of these, I would say. Yet this is leading to 395, which is still 3 million above guidance in revenue. And by using similar assumptions in the remaining quarters, it takes to 1.69 basically, which is like the high end of analyst estimates at the full year. So for ASP here, I assumed the first 2 quarters would be similar to 2024 and slightly higher. And yeah, so year over year, 18 and then 3. And curious to know if you think these are reasonable. And then for the second half, I've gone closer to the second half ASPs for 2023, just because they had fewer customers here. And I'm thinking that there's going to be fewer customers here in favor of higher ASPs in the second half because of the change in focus on the larger customers. And I don't know if I'm convinced by 110 here because, but this is where I don't know whether these numbers here, these hundreds, this is really just the average of the yearly number that they give us divided. And so I'm not convinced that this is going to be accurate. Like maybe this should be lower in Q1 and then higher in Q4. Yeah.
Okay.
And so that's where I am. And then so I have I seasonally adjusted the customers, but then had ASPs stay the same based upon this, and comes out way higher, which doesn't seem.
Okay. Just kind of off the bat, I think you did a great job of building out the model. This looks really good. It's easy to read and has the detail that you want. Some suggestions that I've got just to kind of make it easier is you want to rename implied ASP to ARR per customer. Because you just want to get your the naming dynamic right. And then when we're taking a look at let me just look at the formula that you've got. So go to that 760. It should just be right customer. Yep. Okay. Okay. So this is actually customer. You're looking at the net new ARR over the change in customer. Okay. So this is the
new
so
customer.
I would want to take a look at how is that different than the ARR per customer just at the general level.
Okay.
Because then you can see if prices are rising or falling, and you could begin to model that part in. So that would be total customers and total ARR. Yeah. Okay. So the other thing about the what's happening is you're gonna get two dynamics that are impacting the net new ARR. One dynamic is new logo land, and the other dynamic is Dynatrace expansion. So you want to be able to kind of model those two things separately. Because, right, for example, if you think that like Dynatrace is gonna expand into their customer accounts and like upsell, then you would think that more of the revenue, more like the new revenue will come from there. Whereas if you think that, you're gonna get an uplift from new logos, then, you could kind of attribute, the two, but you kind of want to model those two separately. So you've got your change in customers and then ARR per new customer. You see that ARR new customer, that is assuming that all of the new ARR is from new customers. And, a portion
Right.
of that net new ARR is actually coming from expansion.
Okay.
So, um,
So that would be I'd use net retention rate.
yeah, I believe that they used to provide some data around new logo land.
I think they may have done a few years ago. They haven't given customer information
Since
well, they've given it in the years,
what
definitely
do
the
you mean in
last
the
few years,
years?
like the full year.
Okay. So I think we could yeah. Right. They said 692 for fiscal year 2024 and new logos. And then 140K in land, right?
Okay. What
Was the average land. 140K was the average land.
so what's that for? That's the average per new.
Right. Yeah. That was like the average deal size per new logo.
Okay. So that would be that's the full year.
Yeah.
So are you looking at that's 2024 uh the earnings call?
Yeah, that earnings presentation.
Okay, and you have seven rest
Do you
there.
you see where that is?
From their investor relations.
Yeah.
Okay,
Okay, yeah.
sounds good. My friend's coming with me, but I'm the one buying.
Yeah, so I think it's in like the third slide. $694 new logos and 140K average land.
$692. So now Now, how do you feel about this?
Oh, let me see.
So I've
Yeah, if it
taken
adds up, yeah, if it adds up,
Yeah.
then that's what you want.
yeah, this is just the ARR as a fraction of the year net new.
Right.
So season new and
Well, I think they actually give it every quarter. So I was looking at Q3 and they said it was 209 new lands.
oh
And then
nice.
in Q2 it was 160 new lands. Yeah, so 209. No, yeah, there we go. 209, 160. And then Q1 was 155.
Nice. Okay.
All right. So that's the change in customers. And then so what you can look at is they don't really give us the churn rate. Um, see something.
Yeah. Oh, interesting. So what this is saying is that all of their renewals happen in the fourth quarter.
Mhm.
So,
Okay, so now we have ARR per customer. We have the change in customer on a quarterly basis. I think the next thing that we need to do is we need to estimate the churn rate.
okay.
So to estimate the churn rate, we'll use they tell us that they've got mid 90s dollar based gross retention rate. So the difference between net retention and dollar based gross retention is the the 100 minus the dollar gross retention is the churn. So we would you could create a new line. And you can say like estimated churn rate. Let's start off in Q1. And that was yeah, just do like 100 minus 95%. Yeah. It needs to be 100% minus that. Yeah. Alt HP. There you go. So that was Q1. In Q2, that was also mid 90s. So, also 5% or 100 minus. You could just copy paste over because they use the same language. They're just saying mid. 90s dollar-based gross retention rate. Q3, they're also saying mid-90s. And then Q4, they're also saying mid-90s. Yeah, so you can say roughly about like a 5% churn rate. So so the churn rate, now we can do so the expansion, the net, pretty much like the net net retention rate minus the churn rate is the expansion rate. Okay, so in Q4, now let's do net retention rate. And that was Q4, that was 111%. That was dollar-based net retention rate. Q3, that was 113%. Q2, that was 114%. And then in Q1, that was 116%. So it would, so the expansion rate then would be like 1 minus 116 plus the 5%. Yeah, so it would be 21%.
What's that? 1 minus.
You have to put it in parentheses. Yeah. 1. Oh, that, sorry, you got to put it the other way around. 116% minus the 1. No. You see the order of, yeah. It needs to be W45 minus 1. Yeah. Plus, yeah.
Yeah.
No, that's wrong. The parentheses needs to be W45 minus 1. Yeah,
Nice.
there you go. So now you can say this is like your implied expansion rate. So now you can make an estimate of your, yeah, so below you would say your estimated expansion rate. Okay, and then you can see like what does that mean on a dollar basis? So what was the total growth in ARR? It's 26%.
Yeah.
Yeah, so I would, it's like the difference between the two, pretty much. So you could then multiply that by, or like that's then like the, the growth. But you could, you can subtract. Yeah.
Is this right?
Yeah, I mean, I was gonna say you could turn this into a like a number to say like what was the amount. So for example, if you were to multiply that 21, or you would do the last period ARR, so prior period ARR times, yeah, like 1 plus, but you just want to find the delta, right?
Time 1 plus 3. So I've got
No.
Well-
So you would use that as like the growth rate, right?
Oh, so this.
Yeah. Right. Okay. And then like, you could minus like um, the prior period. Uh-huh. Subtract that.
This one.
Yep. Yeah.
Okay.
But
Confused what this number is.
I think it's because we're looking at year over year, but we're multiplying it quarter by quarter. So
Yeah, that's
we
right.
may need to, make that adjustment.
So,
Since we have since the net expansion rate is at the annual or using the annual, like we'll just have to use the same like base for that. So just keep that in mind.
mm,
So if you go back to the 261,
okay. Yes.
yeah. And then change that to, instead of move to R. Perfect, yeah, for both of them. Perfect. It's okay.
Okay.
So that is gonna give you then the like annual, delta. Um,
So it's the delta of existing customers in annual AR.
yeah. So if you were to look at the year over year, like sequential change in ARR, this would be the contribution that came from the expansion. And then you could subtract that amount by the total amount, and the delta would be from new logos. And then you could do a division to see what was the percentage contribution from each of these. Does that make sense?
Right. So this is
No. I would so what I would do is in the that column or the row that says 216510, that's gonna be ARR from expansion. Okay. And then what you want to do is then below that, you could say ARR from net new logo. And the formula for the new logo is going to be, if you go to that column, what you're going to do is you're going to do W14 minus R14 minus W48. Yeah, that's from new logos. Okay. In that, this is again year over year, But yeah, this is from new logos.
Okay, these are both year over year. Right.
Right. For you to do the like quarter over quarter, you would do the sequential net retention rate.
Okay.
So for last year, last Q4, that retention rate was 119%. So in Q4 of 23. I would put that in row 46, right?
Oh, I see. I thought you said that was quarter over quarter.
Yeah, no, that's the annual. So to get to quarter over quarter, add a new row under 46. And then do like Q4 minus Q3, Q3 minus Q2, Q1 minus Q4.
Of
So that would be the 116 minus the
this.
119. Yeah. Okay, and then the 114 minus the 116.
Okay. Now,
Okay. Now for the expansion rate, okay, that would be that churn.
or you mean Q over Q?
Yeah. And that would the expansion rate quarter over quarter would just be the plus the net retention rate quarter over quarter plus the estimated churn rate. You'll just keep that churn rate assumption the same. So the -3 plus 5. Yeah.
Okay. Now, why are we getting a discrepancy here? How can this be more than the net new ARR as reported?
Yeah, that's a good question. So we're gonna have to that may have to do more with because of how we're dividing it with ARR. So we're not capturing in the growth properly. So now that we have the quarters, you can now multiply the ARR from expand that ARR from expand the ARR from expansion can now be multiplied by the previous quarter.
Mm-hmm.
No. So
But
that expansion rate quarter over quarter, yeah, can now be multiplied by the previous quarter's ARR. I
from
mean,
expansions
you do
or
the growth. You do the growth. Sorry. No, I wouldn't multiply that row. I would multiply that instead of W50, I would multiply W18 or W22. Yeah.
Okay.
Do you have where's the quarter over quarter for ARR supported the growth rate?
Here.
Okay. Okay, because what I would do is like others are gonna have to like do all the subtraction stuff. So you know that what's your growth rate from expansion? It's the 2%, right? In Q1.
Yeah.
Okay, so then if that's 2% and if the total growth rate was 4%, where does the other 2% come from? If you
New logos.
if you subtract the 4% minus that 2% expansion, that's your new logo. Yeah. So you can get rid of all of that like intermediate math, the ARR from expansions and so on and so forth. Because we just need right now just these growth rates.
So this is
New logo.
uh, so,
Yeah.
oh. So you're saying I can get rid of this?
No, you can get rid of 48 and 40 or 49 and 50, I think. Or no, sorry. 50 and 51. And 52. Yeah. You don't need to do any of those subtractions. Yeah, this is much cleaner. Okay. So now you know, so if you look at estimated expansion rate quarter over quarter and that new logo ARR quarter over quarter, the sum of those should equal the quarter over quarter change in ARR.
Right. Yeah. Which they
Yeah.
will.
Right. So now, okay, you can see where the growth is coming from. Or you can I would get those closer. Okay. Now you can go and you can like measure like the actual, you know, uh dollar impact.
Hmm.
Okay, so if I looked at the previous period's ARR, so I need to use the previous quarter's ARR. Okay. Yeah, times the 2%. Uh-huh. Yeah. And then do the same thing with the new logo. Okay. That's your contributions. Those two should sum up to the 47, million in net new ARR.
Yeah.
Yeah, perfect. So this should match. So now you have your revenue contributions. Now you can split out your net new ARR, okay, by the change in customers, and that will tell you the value of, the deals, the new customer deals. So when you look at your net new ARR from new customers, I think that's row 42. Yeah, that W column, W42. Yeah, divide that not against the total net new ARR, but against the net new ARR from new logos, which is the 22060, right? Yeah. Nice.
Okay. Right. Oh. Excuse me.
Okay. So now when you model this, and you can look at what your ARR per expansion is as well. Like, expanded ARR. Mhm. Or I mean, I wouldn't drive. I don't think that there's a reason to drive. I think that the expansion rate quarter-over-quarter is, like a view on net retention is probably sufficient to get a forecast of your estimated expansion rate. Okay, so I would model expansion from net retention, and then I would model new logos, to the ASP, which is the change in customers times that ARR per new customer. Okay. So yeah, you could just estimate what the churn rate's going to be. And historically it's been around 5%. So maybe just maintain that. And you can kind of model in, what you think um the net retention rate is going to be. It looks like it's been sequentially declining though, right?
Yes.
So you may want to think about like, where is this headed? When are we going to trough? Is it healthy for, look at peers maybe? Um, anyway, that's gonna get you to your net retention rate. That's gonna get you to your expansion rate. And then for your new logos, right? I mean, I think you know what to do there, which is you already have the math laid out. So,
Okay. Be the same. So are these just so we're going to do the same again?
right, yep.
Uh,
And then and then you're gonna do okay. So for expansion, you have to start from the percentage, right? But for new logos, you're actually going to build from the math, from the actual number. So if you go to row 52, okay. So row 52 is going to be the ARR per customer, per new customer, times the change in customers. Yeah. Okay. And then what you're going to do is, yeah, if you look at your net new logo ARR percentage, okay, what was the form? What was your reference cell there?
QOQ
Yeah, so you're
ARR.
gonna do you pretty much you just divide it by the past period's ARR. Okay, so now then do the expansion math.
So that's going to be
For the prior period.
of
Yeah.
this times this.
No, times the
this.
current period times the current expansion rate quarter over quarter times the current. Yeah. Yeah. No, but no, you got to multiply. So you always have, because you're projecting to the future, you're multiplying the prior ARR times the current estimated expansion rate.
Right. Okay.
Yeah, there you go. Okay. Okay. So now you can sum your net new ARR for every quarter. First sort of some expansion. The next one is from new logos. Yeah. Total net new ARR. Yeah. Nice.
Right. Then I want to change my revenue. Wait. So then I need to factor in the license roll off.
Right.
Uh,
So I think you need to go to row 23. Okay, go to row 22. Go to row 14.
Okay. So
Okay, there we go. Yeah. So what happens there is you're gonna have the quarterly headwind, the FX headwind. You're gonna have all this stuff. And these are all things that your current net new ARR doesn't count for. Okay. So your ARR forecast is not X roll off constant currency. Okay. It's just total ARR.
okay. So I need to add in
Yes.
these two.
I would say so. That means that no. You want to go to your ARR, your total ARR. No, not the net new ARR. Go to your total ARR, and you should make that the last period plus your net new ARR. So you could, yeah, just the last one. Yep, plus the net new that you have below. Yeah.
Uh-oh.
Yeah. It might be like your customer accounts that the number of customers or something, maybe. If you delete AB 14, just delete it. What happens if you delete it?
Yeah, I just did.
Oh, okay. So okay, your estimated, what's that row? New logo, ARR. Yeah. So you have to make that just is that the right formula?
Well, that's just going to be growth rate, right? I mean, that could just be
Yeah.
equal to.
Yeah, that's not the right formula. So that's okay. Um okay, so our expansion rates are great. It's the net new logo that's off, and that's okay. We'll just for the net new logo, just delete that row in the forecast period. Just delete the 100% and the divided by 0. No, don't delete the full row, but just that area.
This one.
Yeah. Yeah. Just get rid of that. Just delete it. Okay. Now let's do the net new ARR from expansions. Okay, go to that row, 51. Yeah, hit F2. Okay. So that should be times 49 times AB 49. Yeah, AB 49. AB 49.
A, hmm?
49.
Is that not 40? Uh, uh,
Okay. And then we need to look at okay, net new from logo. Hit F2 for that. Okay, actually, no, we got it now. Okay, cool. Perfect. Okay, great. Yeah. So the now what we could do is yeah, make that equal the prior period plus the net new. Uh-huh. Nice. And then the net new logo ARR percentage row, that I think is row 50, that's going to be row 15 minus row 49. Minus row 49. Nice. There we go. And so now we no longer are going to have those circular references.
nice.
Yeah. Cool.
Okay. Wow, that would have taken me like a month to figure out.
Yeah, I'm still going to want to double check a couple of things. Like, for example, I want to double check that um, the expansion rate is the time period is the prior quarter, not the prior year. Um, sometimes when you do this analysis, you actually need to do all the forecasts on a year over year because of the way ARR is. And then you distill it to quarter over quarter. So sometimes that's the case, which can be a little annoying. But yeah, I'll double check that. But otherwise, this is kind of the way that you want to model it. So barring just double checking that we're doing the time periods correctly, does this do you like the logic here? Like, is this more clear? Like, you get how like you get an expansion component and you get a new logo component, and now you can really just like focus on what do you think is going to drive the expansion, or what do you think is going to drive the new logos?
Yeah, makes sense. I can delete these two then,
Okay,
right? This was our first.
right.
I think that.
Just make sure that they're not linked to anything.
Yeah, looks good.
All right, cool.
Yeah, that makes sense. I'm gonna have to have a dig around in this tomorrow, I think.
Nice. Yeah, it's coming along really well though.
Yeah, nice. Um, Great. To yeah, just to go onto the valuation side, we're closed at as in 7.17 multiple, which is nearly an 8% delta from its average since earnings. I see. I think. Did you see anything specific about observability for why they got sold off, or was it just software?
It's just software. Yeah.
Okay, interesting. Because yeah, I don't think observability is going to be seeing as much macro related,
Headwinds.
right, that as software.
Right.
So
No,
it's
I
another
agree.
point. Yeah.
Yeah.
So
No, I like your Dynatrace call. I think that it's actually it's uh I think it's a good trade because it's actually a really good pair versus Datadog as well. Um, because what you're saying is that think for observability, Dynatrace has like a very compelling offering. And so it's not likely that Datadog will be able to really win share against them. Like Datadog is going to continue to grow, but it's not going to win share. But the thing is that if you look at the financial metrics of the two companies, they're pretty similar.
yeah, they're not very different. I don't really get why Datadog has like a twice the multiple.
Right. So I think that means there could be some reasons, like for example, so whatever index that they're involved in, or like who have the ownership. You could see like institutional sponsorship. Those can have an outsized effect, on companies, and
Right.
so that might be the case for Datadog as well.
Okay.
Or that may actually explain the difference between Datadog and Dynatrace, where they actually have very similar, financial, position. They have a very similar financial position, but it's just that Datadog is, got sponsorship. The nice thing about this setup is that, what it means is that, as the results come in, okay, so like right now we're kind of in, I'm going to say like a little bit of a downturn for software. But as those results come in, because they both actually have similar growth dynamics, you're gonna get a pretty, you could get to a re-rating scenario for Dynatrace, um, pretty reasonably. So I think that's something that
Hmm.
that makes it, more compelling.
Nice. Do you think I should go this in depth on Datadog?
Yeah, yeah,
Okay.
it's the right way to do it. Yeah, once you if you do the same analysis on Datadog and you have the models like set up, you're just gonna feel, you know, then what we're gonna spend our time on is like really trying to understand like the differences between the two companies. And that's where like, I hope that like your big takeaway should be that, you want to set up the model because you want to see how if you change a scenario, what's the outcome, right? And you want to see how it like flows cleanly, into the build. Um, for but then the thing is at the end of the day, what you really need to understand are the scenarios that are out there. What
Right.
are the scenarios for Dynatrace? What are they for Datadog? What's driving those scenarios? Are those scenarios like the same for both companies? Or is there like a really strong ideo story? If it's the same for both companies and they're both getting similar growth, I mean, this is where honestly, like this is actually a great setup for a relative value sort of a trade. Um, you don't often get setups like this because typically what happens is the discount or premium to multiples is driven by a quality, an expectation around quality or an expectation around growth. But right now it looks like they're both so similar.
Yeah, and yeah, I agree. I think Datadog is expected to grow like 5% more this year, and then I think a little less than Dynatrace next year. But its multiple is literally twice,
Right.
both Dynatrace and Elastic. I
Right.
guess it does have more share to start with. So
No, this is true, but like for me, um, when I look at these companies, it's like, Dynatrace is about maybe a little less than half the revenue of Datadog. It's like 400 million. Datadog is 623 million. But it's like Datadog's EBITDA is 150 million and Dynatrace's EBITDA is 113 billion. So, that's not like a huge differential. So
mm,
most of the time you do get consolidation and you do get like share you get like leaders will expand their modes and their share, but they have to have like a really strong like excess return kind of profile, and it's Datadog's return profile is not that much better than Dynatrace's, yet it trades, as we mentioned, twice as
mm,
high.
okay. I still have that Datadog model from before, so I can whip that out.
Right. Yeah. I always like to you want to like two-step it, right? So like first step is I would say like get really familiar with like the story of a company, just like the notes that you did for Dynatrace. If you do those same notes for Datadog, that's what's
Yeah.
going to tell you like the setup. And you always want to look at the company like independently, right? First. And then you can go and like update the model and calibrate it. And then you're going to go back to the sell side because then you need to go and maybe put together like a more detailed scenario, analysis. But the I mean we've kind of gone through the process before, but like you're not going to find any sort of conviction until you price the different scenarios. And once you price the different scenarios, you have a lean on which scenario you think is more likely. Only at that point are you going to have any conviction. Other than that, like it doesn't matter if the multiple is bouncing higher or lower because maybe the stock is going to be rated lower, maybe it's rating higher. Like you don't have a view yet, right? The view is really your view on the scenario. What is the scenario that you think is the most likely? And then when you price that scenario, does it give you a good payoff?
Got it. Yeah. So, okay, I'll go through the same. And then, so once you've done that for both companies, is that where you do the same scenario analysis from a relative perspective?
No, you always want it to be bottom up.
Okay.
So you want to be able to I'll give you an example, right? It could be like maybe like ultimately the scenario is for Dynatrace, it's that they are picked up. Maybe there's like growing interest in Dynatrace from multi-cloud vendors of who work with enterprise on leveraging generative AI. So for example, you have companies like Oracle or IBM. These are not real. I mean, they both have like they do have a private public cloud, component, but they're also really heavy in multi-cloud. IBM in particular is like really involved in trying to help enterprise customers develop their own like private or multi-cloud generative AI offering. That business that they just launched last year in July has already grown to like $1 billion run rate. Okay, so and it's been doubling every quarter since they launched it last July. That's IBM. Now, if you find out that what's happening is IBM is adopting or using Dynatrace as part of their solution because Dynatrace has this multi-cloud offering that can be used across, like Datadog too can do this, but maybe Dynatrace is like a better fit or they have this deal with IBM. Now you've got this like tailwind that's associated with that. And if you're like, well, if I think that IBM's business is going to grow by another like billion this year, then what does that do to Dynatrace? That could be another like 150 million in revenue contribution for Dynatrace this year. And no one on the sell side is, really talking about it. This is like a scenario that's out there. So yeah, we just add it to consensus, and that's like the delta. So that's like you see, like that's the outside bit of information that you then apply to whatever model that you have to then see, hey, what would this mean for the stock? Um, and why we use the average multiple is because if the stock has like ripped, right? Then we want to then and maybe like the stock has ripped to an equivalent of like 100 million in new revenue. So you might say, okay, well, there's still another 50 million in new revenue that the market is not like pricing in. When will the market know? Well, it's gonna, this will be some IBM reports first. Okay, so maybe we'll get some teaser from IBM, or if not, when IBM reports, we'll want to know that IBM's business is doing really well. That's a read through for Dynatrace, right? So then you have your whole like stack of the things that you got to pay attention to. That's just like a super hypothetical, but that is an example of like, well, that was an example of like an exogenous factor that would drive your view. And in that scenario, like you're literally taking an exogenous thing and just like adding it to consensus. But what you would also do too is like many times you'll see that in consensus they do have a scenario laid out, but they just start discounting it or they're too cautious on it. And so, that's where you want to like play around with those different scenarios and say, hey, well, what if these actually, come true? Okay, so that scenario piece ultimately is what's going to give you any conviction, on a name. And there's really two parts of it. One is you got to go and you have to like know what are the different scenarios, and then two, you then have to find out like what your view on that scenario is. The scenarios they're composed of the critical factors, right? And usually the way that we do it is like, it's like you hear that, oh, people really love the software. Well, how do you know, right? You got to go talk to experts. You have to see what the expert networks, have to say. Lucky for us, we've got access to like massive databases of this, right? We're on like Alpha Sense, I got Third Bridge, I got Tegas, so we really have like the whole gamut of expert networks to tap into. And so typically when we like mine across all of those, we can find evidence that like maybe a scenario is being like underpriced.
Third Bridge and Tigis on AlphaSense.
No, I've asked them to consolidate, and of course they don't want to. But what I can do is if there's a company that you're looking at, I can, and you're at the point where you're ready to look at the different scenarios and now like try to analyze a critical factor, I'll get the transcript for you and send it your way.
Okay, great. Yeah, please. Anything in observability, APM.
Cool. I'll do that.
Thanks.
All right. Really solid update here, though. I really like the model that you put together. I'd say you're getting really close. Maybe I'll double check some of the math with you just to make sure that we're multiplying it, to the right period. But otherwise, really impressed with your model. Keep up the great work.
Great. Thank you.
All right. Who's next?
I can go next since we're on pricing.
Hey, Andy.
Hey, how are you doing?
Good.
Okay. I'm just hearing the last bit about pricing, which is really a nice segue onto my section. So not too many news update today. So I've been focusing on building out scenarios like we discussed last time, and updating my sell side scrub, and finishing up my sell side table. So I have an idea of like when people are actually bearish on like their commentary, are they bearish on the numbers? So I was doing the comparisons. Wait, let me see if I can share my screen so it's easier for you to follow along. 1 second. Okay, so can you guys see it?
Yeah.
Okay, so this is on Rivian, and so far I haven't done the 1TY or blended forward 12-month analysis. I want to go ahead and see because now we have the Q2 data. Does the 2024 fiscal year multiples actually make sense? So what happens is I pull up this little table here on my Excel. So you can see there are 4 different scenarios here. One is the average implied multiple, so the average multiple since the last big release. So I will say, like, if you look in my chart here, that will be the release of the Volkswagen deal in the Investor Day. So I kind of included the the Investor Day Volkswagen deal plus the production and delivery release into together, because that's where the re-rated up scenario here is on this big step up. So I included everything, and I pulled the average multiple, plug it in here, see what the market sells implied is, and the delivery number. So okay, so it's not too high, not too low. It's like just in the middle, for both sales and delivery. And then on the consensus, obviously it's a little bit on the low end because some people are still pretty bearish. There are some sell side guys out there still don't buy the story. And a lot of people haven't updated their model yet. So there is a little bit of lagging, but for the people who updated, I think half of them are re-rating up. So we'll see how this number goes. But this is kind of like a baseline. And currently, if you look at Rivian stock today, or over the last couple of days, it has been trading up. If we just look at the multiples, you see it kind of has taken off from this 2.4 times level to almost 2.7. So that got me wondering how much of the good news is priced in for 2024, and whether it's justified to be at that level. So, I grab the average ASP, plug it into, a scenario that I think up as a ceiling, which is, without any new shifts, they open up all their line, maximize the capacity, and then they keep the inventory flat, because I think they already got to like 25% lower on the inventory just in Q2. So I would say that's like a reasonable assumption. So I, plug in the numbers, calculated it and realized, okay, so that will imply a 2.78 times multiple, which means the price is around 1762. So today the price is 1571, but the multiple is getting closer and closer to that level. And so I think, okay, so that's the ceiling, right? That's the maximum I'm willing to go with my bull assumption, or like the re-rate up assumption. And what can go wrong? Like how can I make this number lower, or like not as optimistic? So in my recent scrub, like yesterday and last Friday, we talked about the ASP. Some sharp-minded people on the sell side are already start to pick this theme up, because if you think about it, on the gross margin side, there's actually two sides of the story. One, can you get the ASP higher? The second is, can you make the COGS lower? So that's the dynamic. So right now we kind of got the COGS, from the investor day, and it's heading lower. Like we like the BOM cost lower, we like the supplier renegotiation, we like all of that. But one of the things that no one really is talking about, or very few people are talking about, is the impact of ASP. So right now, this is the kind of consensus for fiscal year 2024. And then given we have so many, incentives and promotions, let's, play around with the number. Let's adjust it down. Let's say like $2,000. So that will be this number. So you'll see it dropped down the multiple, dropped down the implied price target, and we're at 2.72 times. So it's awfully close to 2.68 times that the stock is currently trading with. So it's getting close to that scenario. But there's another trick up, Rivian's sleeve with is they might be having 200 regulatory credit, 200 million to add on top of the sales. So the scenario is, if they actually have the ASP up and being able to deliver all of those vehicles without using the reg credit, it's like a clean sheet, then I would say that's a re-rate up scenario. Like it is okay to trade at 2.8 times, even like 3 times, if the market is pretty optimistic about it. But if some of the revenue is made up about around the regulatory credit, then the number is not as clean. So I see some of the sell side views is, even though you don't make gross margin positive in Q4 and then you have like a clean number, we like it. But if you're trying to, plug in some regulatory credit here and there, try to make the number look pretty, it's actually like, I wouldn't call it red flag, but like an orange flag on their future growth, because those regulatory credit is like more less predictable. It's more like a one-time thing. It's not like persistent throughout the quarters following. So this is the setup right now, and so I'm actually bull, into the production delivery. I'm pretty happy where it is trading now, but I'm starting to get a little bit cautious if it keep moving higher. Especially without any new news coming out before the earnings. And if it trades above, I would say like 2.8 times, I'll be on the cautious side, because this like re-rate up scenario is one of my most bullish scenario. But what can go wrong is Rivian come out and say, oh, actually, we're opening up our third shift. where we're increasing to maximum capacity, then, that scenario is another re-rate up like above 3 times. That's a different story. But we don't want to go there yet. They're still ramping up. So this is kind of like my scenario breakdown for now. And I just want to hear your take to see if any idea can come out of this, or like, am I thinking about it in the right direction, or am I missing something here?
Well, I think you did a great job, Andy, of kind of laying out your different views and the scenarios and how those impact price. I think that this is exactly like the way that you want to approach it. So fantastic job on doing this. Um, I think, kind of a couple of things to think, just like additions. Like I think I would actually say that your analysis is very solid, and for example, like you'll understand that the upside case is contingent upon an increase in production, right?
Mhm.
Um, Probably, so the thing from there is that probably if there is going to be an acceleration in like KPIs and metrics, you
Mhm.
could get the multiple expanding, beyond what's defined in the range. And
Right.
how would like the way that you would try to figure out where the multiple can go to would be you take a look at where the revenue, like, estimate could be,
Mhm.
um, in the future. And, and then you look at to where like, okay, well then that's the price. And then what if I look at what the price of the stock would be at that time, like say the EBITDA, at that time, what is it, what would that get me to today? What would the multiple be, today? So
Okay.
that's you can kind of tease around with that. The way that I like to think about it is like you think about like the curves, right? So it's like
Mhm.
you're not just shifting up, one quarter's revenue. If they increase production, if they add a new third shift, this has a down the estimate, right?
Yeah.
Impact. It's going to
Mhm.
impact this year, next year, the next 10 years of forecasts.
Mhm.
So you're going to want to be cognizant to that because that can drive a pretty significant re-rating higher or lower, right? Well, when that's the case.
Right.
But
So,
other than that, yeah, I
okay.
would say this is really good.
Oh, thank you. So I want to like ask you, on that last point. Does that mean here, for example, right, in this chart here, on this Excel, I can have something like, I don't know, like 2027 fiscal year, and then it will be like EBITDA rather than just sales. Right. I'll do the same analysis I did here, and then I'll perform it on EBITDA.
Yeah. That I mean, we're always going to want to do that. That's what we call an earnings waterfall, right? So
Hmm.
you build your scenarios pretty much around sales, and then
Hmm.
or like margin, and then you just want to see like, how does it impact, each of the line items, right? And then
Hmm.
so say for example, you have you increase all of these numbers, and then you think that you could get to like an EBITDA of like 10% in
Hmm.
2027. So maybe that's like, 8 billion or I don't know, like say 4 billion in revenue.
Hmm.
And now you have to think about like, okay, well then what 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 does 4 billion in revenue like or 4 billion in EBITDA, what does that tell you about where the stock is going to trade? So
Hmm.
the way that you would do that is you could look to see like what are like comparable multiples at, like how are
Hmm.
companies, trading if they're trading on the EBITDA, basis, and maybe they're trading at like, I don't know, 10 times or whatever. So then if
Hmm.
say, okay, if the company trades at 10 times, then what would that be? What's the enterprise value? And maybe you get to an enterprise value of, X amount. And
Hmm.
then if that enterprise value is, whatever that new number is, then you could take today's price first that, and you'll get to a multiple. You'll get to like a new multiple, and that'll tell you where like the current multiple can go based upon your future view of what you think will happen to EBITDA.
Okay. Okay. I see. I see. Yeah, that's actually super helpful. Okay, probably gonna do more work on this, but also gonna apply to other stocks in the coverage. And yeah, I mean it's nice to have a little bit of quiet time when there's no like new data coming out before the earnings. But yeah, not gonna last too long. Almost a week or like 2 weeks away from the beginning of earnings season. So yeah.
It's
Um,
going to be fun.
yeah, yeah, and also on the sell side scrub and the multiple analysis throughout the earnings log, it like I messaged you last night, it's actually a super helpful experience because for example when I'm looking at this multiple here, I kind of already know what happened in history that led to this stage. Like what is this high, for example? And we're
Right.
slowly approaching that. Like why did we unwind, right? So like like I used to did my earnings log without the multiple in it, so I kind of just have like one side of the equation. I don't know what the market is thinking,
Uh-huh.
but after that it's like, okay, I know what the market thinking, I know what the market was expecting into and out of an event, and that just makes perfect sense. And it's kind of also on a similar vibe today, when I'm not saying it's going to happen exactly like that, but it's the setup is slowly getting there. So
Uh-huh.
it might not trade at a premium, but like if it goes there, then I know what to do. Um, so yeah, and then the ASV, I think it might be across the industry because the one of the sharp sell side guys said it's the pricing pressure is coming from everywhere. Not just these not just Rivian. Um, so it'll be interesting to see what the ASP affects, on the revenue side, because even though we have a really upbeat production delivery, it might not be smooth sailing into the earnings.
Right. Um, quick question actually on that, which is, did
Mhm.
you get a chance to take a look at um the like GM and Ford or the legacy OEMs?
Not yet, but that's on my list to do. I'm gonna check out. Like, is there anything specific that you're looking for?
Really want to know what their view on production is. Like, is production for like the next quarter or for the year like rising or falling? And ideally, like
Okay.
the most current, the better.
Okay. Yeah. I'll be putting it on my list, and hopefully can give you some kind of update in tomorrow's meeting.
Okay, perfect. Thanks,
Yeah.
Andy.
Yeah. No problem.
All right. Well, we got Yafang still. Want to walk us through macro?
Yeah, I mean, like today, like the main thing is the Powell's Congress testimony. I was kind of like watching it, like watching the replay. So like, yeah, I think like a lot of like the you kind of like avoided commenting on a lot of the issues or like questions regarding like when are you gonna do like a rate cut. Although like he does like recognize like the risk is more towards like a balanced one. So like before then, I think it's more focused on the inflation side of things, but now he is acknowledging like the labor market is like it's really cooling. Like now they're gonna like focusing on both like the inflation and like the labor market. So like that's kind of like the balanced risk. Yeah, I mean like judging from like the market's reaction, I think the rates kind of like steepened, as like Andy mentioned. Like they so I think let me check like the Fed watch. I think the cutting like probability for December should like decrease. I'm gonna double check again. Let's see. Okay. Oh, it's actually like not changed too much. Yeah. So we're still like looking at like 2 cuts at December. But yeah, I think the rates sold off a little bit. Also like the dollar went pretty strong. So yeah, I think both like euro and like cable, like they all like fell a little bit. So yeah, I mean, we're like talking about like a possible like July cut for a while. But like judging from like his testimony today, I mean, I think he's still like more like on the wait and see mode. He wants to like see more good inflation data. He's think like the most recent inflation report is like a one good data, and he wants like a little bit more. Usually like we say like three data points make a trend. So I'm not sure like if he's gonna like wait till like September, but I mean just like judging from his like answers today, I think I'm probably like a little bit less confident about like a July cut. I think probably like a September cut is like more likely. But I mean, like how much will the cut be is like the issue. Yeah.
Mhm.
I mean, like in the meantime, like we will get like August. We will have like two more inflation data points and two more. No, we actually have like three more inflation data points. We have like Thursday CPI. We actually had we before like September meeting, we will have like the August and September CPI. We'll have like two more labor data and two more like NFP print. So I think at least like on September he will get like enough data he wants, and there won't be like more like we need to see like more good data. We need to be like more confident. I think September is kind of like a more like do and die moment, but like July, I mean, just like after today's like Congress, like his answers towards like the committee's questions, I think like July cut is like I'm kind of like assigning a lower probability to that. Yeah.
Mhm. Got it.
Yeah. I mean, what else? I mean, it's just like a
Good question. Sorry, I
yes.
was trying to unmute myself. So even though, okay, so you think the July pricing is like lower after today?
Yes.
Is the market already reflecting that view?
Yeah. I think like before that we're looking at like 8%, like 9% of a cut. Like I'm right now seeing like 5%. It's like
Okay,
less than
gotcha.
5% of like probability of a cut. So yeah, I mean
But do you think that the CPI is going to change that number a little bit? Even though it's like a low probability, is there still a trade to be done around CPI? Do you see any juice here?
ah I don't really see like a significant. I mean there might be like something in the I don't know like the equity markets, but I mean I don't see like a lot of like juice right now in the race market. That's for
Okay.
sure. I mean we all know like the disinflation trend is still intact.
Mhm.
Um yeah. I mean it's I'll probably like do a like a CPI preview like from like by tomorrow because I already like received like a few sell side reports on this. I mean in general like the disinflation should like just like keep its trend. Although like I
Mhm.
do see like for example like Morgan Stanley has mentioned like there might be like a small rebound in like July's data, but like we'll see. Yeah,
Okay.
I mean
Yeah, looking
it's
forward
just
to read
like
that. Yeah.
yeah, it's just like there's like not many trading days towards like the FOMC. I mean it's like about like more than about like 15 trading days. Yeah, I mean, it's just, I mean, I just like Powell doesn't seem to be like willing to cut this time. I mean, it's, I think more like it's about like the September, how like
Okay.
the ensuing like labor data and like the inflation data kind of like
Mm.
render this decision. Like, is he gonna cut 25? Is he gonna cut 50?
Okay.
Or like even more? I mean, that's probably like more
Like a more
interesting.
juicy, right?
Yeah, it's probably like a
Yeah.
more interesting bet to play. Yeah, but for like July, there's like, I mean, it's really like a tail scenario right now. I mean, and you really, I don't think that's kind of like the way to trade it. I mean, of course you can like put some like really like unit options. It's like 5 delta, like 6 delta. I don't know. Like if you just like spend like a very little premium on like a really like far OTM option, then I mean for sure like that's kind of like a beer money. But I mean I'm not gonna like bet big on like a July cut right now. Yeah.
Gotcha. Okay. So basically, you think like the market is pricing like roughly where it should be.
Yeah,
Okay.
yeah. Yeah, I mean it's just like the
Okay.
yeah.
Yeah. Makes sense.
Yeah. Right. Yeah. I mean, it's just like we have to wait till Thursday before like any significant data coming out.
Gotcha. Any interesting take on that, Mo?
I think that we're definitely like in an interesting period where the market is pricing in 2 cuts for the year. I think I've walked through I put out, my notes for on the macro side, which is, the data is pretty much just, trending lower. We've got weaker new orders, CapEx survey soft, business formations weaker, building permits falling, unemployment rate rising, savings rate is below average. That's going to shift higher. Home prices and rents are starting to move lower. Auto prices are moving lower. So all of the data is showing that the economy is cooling. When I went through and I scrubbed sell side, now everyone has a talking point on the surge in immigration. And part of this is because the CBO, the Congressional Budget Office, put out a report sometime very recently where they modeled out what they thought the immigration trend was going to look like. But it's like in my view, it's completely wrong, like absolutely wrong. They're modeling like a 1.1% increase this year, 1% next year, and a slow taper back down to 0.3%. Okay, like that's what their view is. In
Like on
reality,
immigration?
yeah,
Okay.
that like net immigration. So they're looking at like the change to the population growth in the United States, and they're looking
Ah,
at
okay.
like they're saying that like total population growth is going to be like over 1% for the next couple of years.
Right.
But in reality, if you look at, so there's a couple of things. One is that that's that like I don't know how they're coming up with that because when I look at current border crossing data and immigration data, like current data, we're already tracking below last year and the year before that. A big thing
Right.
is that there's been a fundamental flip in the immigration story because the Biden administration has begun to clamp down on immigration and restrict it,
Mm.
and that's gonna stay because that's become a political issue. On the flip side, right, if Trump becomes president, then we're gonna get that to even the next level, right? It'll be even more
Yeah.
restrictive. So the right analog for, or the right analogy to understand where the path of immigration is going to look like is actually the 2014 to 2018 cycle, where you saw like a 1 year growth in immigration of like say 1%, and then a really rapid deceleration back down to like 0.3. And so if you look at the like 5-year average of CBO, they're saying that the immigration impact to total GDP is going to be significant for the next 5 years. In reality, they're overstating it by, you know, they're I estimate that they're doubling the impact from immigration, and that actually that immigration headwind, we're already in that. Like the regime has already flipped. So what's funny is that they came out with this paper like a couple of weeks ago. Brookings Institute, which is this Washington think tank, they went off on this like they then like wrote another like 80-page paper based upon the CBO data, the CBO forecast. And then now it's going and doing rounds where like everyone on the sell side is talking about the CBO data and the Brookings Institute report. Nick Timmeros quoted the SF Fed, who put together an analysis showing that the break-even rate for non-farm payrolls is actually much higher now because of this surge in immigration. It's just it's so funny because it's like the CBO made a forecast based upon data that was hot last year. Okay. Now they're extrapolating that into the future. Okay. So they put out a report showing that. And then everyone is writing like even longer reports, with their like take on what they think is happening. And it's just like hilarious because the truth is actually that regime has already flipped. It's gone.
Oh
The
yeah,
tailwind is
it's like an echo chamber, and what's funny is I guess at that point people are just, I think, having that confirmation bias. It's like they want to cling on to that theme of like the immigration that we talked about like in like February or like earlier this year, and they want to cling on to that so hard and coming up with all that. But
right.
I mean when it flipped, like there's no point extrapolating that number anymore.
Right. It's gone. Exactly. Yeah.
Right. So I mean that will get like people on the wrong side though.
Right.
If yeah. So I mean I actually read the birth death like model like from anyone, and and like updates, and then like how she wrote it, and the NFT number before. Actually, she was talking about like, yeah, like there were these like themes that going on that could explain the labor market strength. Um, but if the birth and death model is true, then we found the smoking gun kind of scenario, like, and I was
Right.
like, yeah, like, it's in the beginning of the year, like everyone's kind of wondering like what's going on, right? We couldn't find a smoking gun. But if anyone's correct, then we should move on. Like I don't think it's a good idea to linger in the past. We need to you know we can't just drive and look in the rearview mirror. We gotta look ahead. Um, yeah.
Right, exactly. So that's where like BCA and Pantheon, those are independent shops. They are, highlighting the birth death model and the revision
Yes.
data. So they're kind
Yes.
of in our camp. And
Yeah.
I would say that they're more bearish. I'm not super bearish. I'm just like I just think that expectations need a reset. Like clearly
Hmm.
everyone is expecting that there's this like big immigration surge, but it's no longer here, right? So
Right.
that's just going to be a readjustment.
Right.
But I think that also will warrant, Fed like more cuts. So
Hmm.
I think Yefeng was saying about how Shepherdson thinks that the Fed's going to cut 125 basis points this year, 25, 50, 50. Yeah, I think that's I'm pretty warm to that. I would almost say that, you could get like no cut in July and you could get a 50 cut in Sep, like we could
Yeah.
start at that point. So,
I mean, that's kind of like my base case right now. I talked about this like earlier, after like hearing
yeah.
like Powell's like Congress like testimony. So yeah.
But that will like evolve quickly into like the '08. No, I went back and checked some of the the '08 things.
Right.
yeah, like you suggested on last Friday, and I was like, wow, okay, so like you got 50 cuts, and then you got like in between meeting cuts, and it's like crazy. So, but yeah, like I think a 50 cut in September will send out that message, uh, and people start to price further cuts in, very quickly on the curve.
Right. I think like a big thing is uh so if you I mean this is like the trade that I'm like ready to like put on, which is
Mhm.
I think it's gonna be too hard to try to do like it's very hard to trade like the July and Sep, but I think just trading the Ds and then also like so for like next December because the market is pricing like a higher for longer, scenario. And I think that is that's gonna be off. If I look
Yeah.
at
Yeah, what's the spread between the Sep and December? Like,
yeah, so SEP is 75 percent of a cut, or say 71% chance of a cut. And then
okay,
December is pricing in two cuts, like just about two cuts. So like that's, you know, so the implied rate for September is 5.14, and the implied rate for December is 4.827. And if I look at the SOFR curve, I can look at like, yeah, it's still, I actually, interestingly enough, over the past month, it's actually flattened pretty significantly. So I think the market is, you know, acknowledging this. Uh, Let me show you
okay.
guys a little like what I'm
Yeah,
saying.
so
Yeah.
like Sep December is like 33.5. Ah, okay.
You can see how like December has moved by almost two cuts. December 25. Yeah, so D's right now and SOFR it's at 513, which is pretty much like in line with the yeah, it's at 513.
Yeah, I think the difference between the September and December, if we just like uh, approximately regarding that as like the bips of cut. So right now the spread is at like 33.5 bips. So that's around like one cut and a little bit more.
Mhm.
Um, yeah, I mean, if like in between September and December, we're expecting more cut than this, then we should probably like short this, like short Sep, long December. I think yeah, that's probably it. That's like the difference will be higher. Like say like if we take the Shepperson's view of like 125 bips of cut, then that's kind of like a 90 bips of like uh, profit range basically.
Right.
Yeah.
Um, I think the question though is like when do you get paid? And I think that the data in August and late summer is where we're going to find out. So we're going to find out like the trajectory will happen in late August, early September, I think.
Yeah. I mean, like the
Yeah,
good
so
thing
the-
about this, like future spread is like the September contract will expire in December, so like we can just like hold it.
Right.
Yeah. But yeah, I agree. Like I think Fed's probably like putting more weight on like the labor data than inflation data. I mean, starting from now, I think. I mean, as things like they're saying like putting this like as like a balanced risk. That's how they're like uh, expressing their views. So yeah. So I think the next two labor data will be like very important.
right.
Yeah. And yeah, we
Okay.
always get like weeklies, like initial jobless claims, and that can give some hint as well. Yeah, and I think for this Thursday, it's just like CPI and jobless claims. Yes.
Yeah, the big things that are really gonna matter. All right. So we've got some macro heavy stuff to think about this week. We'll get some more clarity on the path of inflation by the end of this week because we'll have CPI and PPI. So we'll have a pretty good understanding as to what the setup will be for the FOMC meeting. Yeah, I think and we'll get more of an idea, by the end of this week. So I'm not like in a rush to speculate, but my thinking is probably just like heavy job owning, like an 80% chance of like a heavy job owning, and maybe a 20% chance of like a cut. I would say like that's kind of the setup I think I would anticipate for July. And then from there, it's we get some important data in August. Now, the other important thing too is like through July, the second half of July, that's when we're gonna get earnings season data, and we're gonna get good understanding as to like the positioning of companies and what's happening kind of on the ground. That'll be really useful for us because today we got the NFIB, right? Business
Yes.
survey.
Yeah,
And
that's
that
kind of like warmed up a bit.
the thing about that is yeah, it's quite weak. Like,
Right.
the plans to increase employment was flat, plans to make capital outlays was flat. Um there was like a small like improvement in the net that expected the economy to improve, but keep in mind that that's negative 25%. So like,
Yeah.
okay, you went from negative maybe 30% to negative 25%. Like that's not a huge difference. Instead, what we're getting is, the job openings are declining, and we're just not getting a the kind of shift, that we would need. So that makes me feel very very cautious of for the labor market and for hiring.
Yeah.
This is taken in context with like what's happening in you know uh with ISM data, it just shows a softer economic backdrop. Okay, guys, that was a good catch up, a good review. Let's go ahead and we got things to kind of get some updates on. So I'll go ahead and let you guys go, and then we'll touch base again tomorrow.
Perfect. Okay, I'll get you the legacy OEM update tomorrow.
Perfect. Cool.
Yeah.
Nice.
Cool.
Thanks, Mo.
Thank you.
All right, guys. Take care.
Take care.
Bye.
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 Bye.